Why we think today real estate actually makes a lot of sense. The reality is real estate is a cyclical asset class, and clearly it has been out of favour for the last 5 to 7 years. Now let's not forget we had an extraordinary washout of QE and negative interest rates, and one of the world's worst bond markets we've seen for over 50 years. So for there not to be a fallout for commercial real estate, I think would be quite bizarre. And so what we have seen has been that washout, but what we have today through the listed real estate sector, the REIT sector, is best-in-class operating platforms and portfolios. Believe me, this is some of the world's best commercial real estate. These REITs, and I'll demonstrate, we've heard all the problems with private credit. This is not the REIT market. The REIT market actually has superior access to capital, and they're in a position to take advantage of the distress and duress that we are going to see in the private markets. But let me also stress that the operations of real estate today are actually incredibly solid. Right? We are seeing high occupancy and low supply. Real estate is a simple game, supply and demand, and the supply picture is critical that differentiates it from other investments because the demand side is more a function of economic growth and corporate profitability. But what we're seeing is that on the supply side, very limited levels of supply. That sets us up for a very strong period of time. The other thing that we're hearing about is liquidity, and again, we've been fortunate, again, because of things like QE and low interest rates, we've seen a flood of liquidity. So liquidity has been underappreciated, and we think this is going to be a more important aspect in the years to come. But most importantly, the thing I want to impart on you today is this last point. You've heard lots of people in equities talk about intrinsic value. I'm never quite sure what intrinsic value means other than they use the word to try and convince you it's good value. Real estate's intrinsic value is replacement cost. And what we're seeing today is a very, very unusual set of dynamics. We have a situation today because construction costs, as anybody who's built a house in the last 3, 4, 5 years would tell you, have gone up exceptionally. Construction costs are up somewhere between 20 and 40% in the last 5 years. And that's why we're seeing a number of construction companies go bust at this point in time. At the same time, we've seen property values go down by about 20%. Now, property value is made up of two components, the land and the building. The building costs have gone up 30 to 40%, and the property values have gone down by about 20%. What that means is you are now buying property values at or below the building cost. You're not paying anything for the land. So you are buying intrinsic value in a cyclical asset class that has had the crap beaten out of it over the last 5, 7 years. So we have an exceptional set of circumstances. This is a very rare opportunity in terms of a position where you can buy real estate at a discount to the physical at a time we can see high occupancy. Now usually what we see is a lot of vacancy, and therefore property does trade below replacement cost because you're going to have to soak up that vacancy before the landlord has pricing power. What we're seeing today is high occupancy and very, very modest levels of supply. Yes, we're seeing, okay, so this chart, the bar represents the typical range of supply that's delivered into the market as a proportion of the existing stock. So picking retail, for example, sometimes at points in the cycle, you get an additional 4% of shopping centres added to the shopping centre market at any one point in time. Historically, it runs at about 2%. Today, there's virtually no new shopping centres being built. We're seeing, obviously, very little supply of office. Now, justifiably so. We're seeing only modest levels of multifamily. Now, this is just multifamily apartments. These are apartment buildings the US built for rent. We're seeing very limited numbers of single-family homes being built. So when you look at the overall supply of housing, including apartments, condominiums, and single-family homes, it's running well below the historic average. Hotels. You know, anybody again who's travelled in the last 2 years will tell you hotel rates are probably 20-30% above 2019, and yet there's no new hotels being built. So anybody that thinks that hotel rates are coming down anytime soon, I've got some bad news for you. Unless we see a massive economic contraction, and that's the demand side. So overall, what we're seeing is this red bar, the current level of supply, is sitting below the long-term average at a time when we have high occupancy. Usually when you have high occupancy, you'll see elevated supply. So we have a situation where we're trading below replacement cost, where we have limited amounts of supply and high levels of occupancy. And again, the thing with real estate, location, location, and not location, but balance sheets. They're the critical things to look at when you're investing in real estate and REITs. So if we look at the balance sheet of the REIT sector, leverage is at the lowest levels we've seen for over 10 years, much stronger than when we had the GFC. So the REITs are in great shape, and they do not rely on banks or private credit. The majority of the debt derived, particularly in the US European REITs, is from the capital markets, from the bond market. They're investment grade rated, and so they can access capital market debt. So that puts them in a very strong position with limited amounts of floating rate debt, long-term duration on the debt. The dividends are covered. They're not doing a lot of development at this point in time. So as a consequence, the REITs trading at or below intrinsic value with strong balance sheets, they're in a great position to take advantage of opportunity. Simple game, simple story, great time to buy. Thank you.